So today we'll be starting with the cost concepts. See, when we are talking about the cost concept, let's first try to understand the different terms related to cost. The very first term is cost, in which when we talk about what is a cost, we are talking about that it is a kind of a sacrifice that we make, and that sacrifice is usually measured by the amount of resources that we give up so that we can achieve a particular purpose. And when I talk about a particular purpose, that purpose is nothing but manufacture of your goods or service. If you're talking about the goods, so it is production of your goods. And if you are talking about the services, then we are talking about rendering of the services, right? And if I talk about this same cost, we can say it is a kind of a measurement. But this measurement again is in monetary terms about the amount of resources that you use. Because when you are talking about manufacture of the goods, so in that case, you have to give up certain resources so that your actual goods can be manufactured or your services can be rendered. The associated term with cost is costing. See, when we are talking about this costing, first of all, understand that it is a technique, right? So the technique and the process of ascertaining the cost, the process of calculating the cost, so that in that case, you can allocate the entire expenditure, the entire cost to every order, job, process, service, unit, depending upon whichever is applicable in your organization. Then there is one more related term that is known as cost accounting. Now, when we are talking about this cost accounting, we are saying that it is a technique for ascertaining the cost of products or the services, right? See, when we talk about accounting, accounting is basically related to, identifying the transactions, then you record them, and then you further classify them, then you allocate them. So the same thing is to be done in case of cost accounting also, where you classify your costs under different parameters, then you record them, and then you uh, actually allocate them. Because until and unless you allocate the class, until and unless you allocate the cost, you will not be able to justify that what exactly is the cost of production. And whenever you are into a business, you actually have to ascertain the cost of production. Then only you can decide about the price of your product. Now, when we are talking about this cost classification, cost can be classified based on different parameters, right? So those different parameters can be based on your nature, element, or behavior, or functions, or direct and indirect cost, or on variability or controllability, and there can be many other parameters. So based on your requirement, you will see that, okay, this is the characteristic that you want to take into consideration, based on which you will be actually segregating it or categorizing it. We start with the first one, that is the behavioral classification. Behavioral classification basically means when we are talking about the different types of costs based on the level of production. And based on the level of production, we have three different types of costs: fixed costs, variable cost, and mixed. So in that case, whenever we are talking about fixed cost is the cost that will not change with the change in the level of activity. Say, for example, I have a hospital where I can treat 100 patients, right? So in this case, when I have a hospital of treating 100 patients, so that means whether I treat one patient or I treat 100 patients, my fixed cost, that means my cost for that building remains the same, right? So that will not change. Even if I have taken that building on rent, that will remain the same until and unless I want something extra, right? So when we talk about this fixed cost, we say my total fixed cost. Suppose I purchase the building for, say for example, 10 crore rupees, right? So that 10 crore rupees is constant and that will not change, right? Now, In this case, when I say that my building cost is 10 crore rupees, so whether I treat one patient or I treat 100 patients at a time, my total fixed cost remains the same. But if I say I treat one patient, so I would like to recover my amount from that one patient, my fixed cost. But if I treat 100 patients, so my entire amount is divided among 100 patients, right? And if it is to be recovered from 100 patients, so in that case, it is divided among them. So in that case, what I see is that my per unit fixed cost that goes on decreasing with increasing number of patients or increasing number of units, right? Total remains the same, per unit goes on decreasing. Next is my variable cost. Variable cost is the cost which is in direct proportion to the level of output. Because if I'm talking about my variable cost, say for example, I'm taking the direct material, right? So if I'm producing or manufacturing just one unit, so I need material only for one unit. But if I'm producing, say for example, 100 units, so I need raw material accordingly. So that is in direct proportion with the number of units that we want to produce. So your total variable cost will keep on changing with the with the increasing number of units. So whether I'm talking about direct labor or direct material or power or salesman commission, all these are examples of your variable cost. So in this case, you can see that your variable cost per unit, say for example, my variable cost per unit, that means I'm talking about direct material right now, is 10 per unit, right? So if I'm buying one unit, then it is 10. If I'm buying 100 units, then it is 10. If I'm buying 1,000 units, then it is 10. 10 per unit. But if I'm considering the total variable cost, so in that case, it increases with increasing number of units. One unit, it is this much. Two units, this much. Three units, this much. So that means as your number of units goes on increasing, accordingly, your total variable cost also keeps on increasing. So it becomes a rising curve. Now, next is your mixed cost. Now, when we talk about mixed cost, it means it is neither entirely variable nor entirely fixed in nature, right? So in this case, what we have to do is that we say that it has characteristics of both your fixed as well as variable cost, right? So mixed cost can again be of two types. It can be semi-fixed cost or it can be semi-variable cost. Now let's see what is the difference between the two. When I'm talking about semi-variable cost, that means up to a particular level. Say for example, you have a landline telephone connection, whether you use it or not, up to a particular level, that means that minimum rent is to be given. Suppose my minimum rent is 1,000 rupees. So that means this 1,000 rupees is to be paid even if you are not even touching that phone. You're not even using it, right? And suppose 100 minutes are given free to you in that 1,000 rupees. You are going to utilize those 100 units, 100 minutes. And after those 100 minutes, suppose you even want to use it further. So that means every increasing unit will be charged, right? I repeat, up to 100 minutes, you have to pay whether you use the phone or you do not use the phone. But the moment you cross those 100 minutes, then every additional minute will be charged at an increasing rate. So you can see, then it becomes a rising curve. So that is the reason it is known as semi-variable cost. Next can be semi-fixed cost. Semi-fixed cost is fixed over a given range of activity, and above that level, the cost will suddenly jump. Then again, it will remain same over a given level of activity. Then further any increase, again, it will jump. So in this case, suppose I have suppose again, a hospital, right? And I keep, say for example, one nurse on every 10 patients. So if I have one patient or I have 10 patients, I just need one nurse, right? But the moment my number of patients increases from 10 to 11, then in that case, I need one additional nurse. So my cost increases. It jumps to another step, right? So in this case, now whether I have 11 patients or I have 20 patients, my nurse requirement will not change, and I just need 2 nurses and I'm able to cope up with the present situation. But then again, when my number of patients increases from 20 to 21, so from 21 to 30, again, it will be same. So that is, you can say, a step up kind of a pattern that is formed over here, which is known as semi-fixed cost. Now, this was your classification based on the behavior. Next is the cost classification based on the purpose. Based on the purpose, we have production cost, or which is also known as product cost, and period cost. See, whenever we are talking about this production and period cost, both of them will be either fixed or variable. That means they will fall into the previous category. So all the classifications that have been given over here, they are not mutually exclusive. They are mutually inclusive. One category will fall into the other one, right? So as a result, we cannot say that, okay, if I have taken one classification, so it is not being covered in the second one. No, they are covered in each other. Starting with the product cost. Now, when I use the term product cost to understand it in a very simpler manner, product cost means I'm talking about the inventoriable cost, or it is the cost without which you cannot manufacture a product, right? Without such cost, your product will not be manufactured. It will not come into existence, right? So as a result, all the costs which are product costs, they are a part of that portion of cost which is very much necessary to produce your product, right? Now, after your product cost, the question arises, what exactly is included in, what all is included in your product cost? All kind of material, whether direct or indirect, all kind of labor, whether direct and indirect, and all the manufacturing overheads, that is both fixed and variable, they will be formed as product cost. Now, next is your period cost. Every cost which is not a product cost is a period cost, because in case of costing, every cost has to be defined either as a product cost or as a period cost, right? So in this case, if it is not a product cost, then it is a period cost, right? So in this case, we include all the examples related to your selling and administration cost, your research and development cost, advertising, sales commission. That means anything which is not a product cost is your period cost. Everything is being covered over here, right? And all these costs are the costs without which you can manufacture your product. I repeat, the product can be manufactured, but the only thing is that your business will not be conducted. Because if I'm not incurring advertising expense, so I will not be able to move ahead with my business, because I need to advertise. Then only then I'll be able to, move ahead in the business. I'll have more sales. Then I need to pay sales commission to the all the sales workforce. I also need to spend some money on research and development so that I can improve my product. So all these things are to be taken care of, right? Now, after this product and period cost, we have another method of costing, which is known as absorption. Now here we will be studying two methods of costing. One is known as absorption and the other one is known as variable costing, or what we call it as marginal cost. Absorption costing, which actually means full costing. When I use the term full, that means fixed and variable, both the components are taken into consideration, right? So in this case, what will happen, that whether I'm talking about variable cost or I'm talking about fixed cost, both are to be considered while valuing your closing inventory, right? So every finished unit in your inventory, it will include your variable as well as fixed cost. And when I talk about absorption costing, see, I categorize my total cost into, as you know, that cost will be either product cost or period cost. So I say under product cost. Product cost is the cost without which you cannot manufacture the product, right? So that means I'm talking about all the variable components. That is direct material, direct labor, direct expenses, and variable manufacturing overheads. But as I told you, in case of absorption costing, it is full costing. So even fixed manufacturing overheads are a part of your product cost. And apart from that, if I consider the period cost, then all non-manufacturing overheads, whether they are variable or fixed, they are a part of period cost, right? That is absorption costing. Now, there is a different way of maintaining costing that is known as variable costing. Variable costing, as the name suggests, it only includes variable components. That means it will include direct material, direct labor, and variable manufacturing overheads. The fixed component will be considered as a period cost, not as a product cost, right? So, and when I use the term variable costing, it is also known by the name of marginal costing. And this variable and marginal costing is a method of costing which is usually used for internal purpose. And when I use the term internal purpose, that means you are not going to give these figures to the outsiders. When you need to go for your own decision making, when you need to decide certain things, then you use this marginal costing. So the overall total cost under marginal costing again is categorized into product cost and period cost. Product cost means again your variable components, that is direct material, direct labor, direct expenses, and variable manufacturing overheads. In this case, the fixed manufacturing overheads are shown here under the period cost along with non-manufacturing overheads. That is the basic difference between your variable and absorption costing. So the basic two differences among your absorption and variable costing is in the treatment of fixed manufacturing overheads, how to treat them, and the presentation of income statement. When I'm talking about the treatment of fixed manufacturing overheads, as I told you, in case of absorption costing, your fixed manufacturing overheads are treated as a product cost. That right? That is, it is treated as an inventoriable cost, whereas in case of variable costing, they are treated as a period cost, right? So when I'm talking about the same thing with respect to presentation in the income statement basically means I'm talking about the P&L account, right? So in this case, you can see when I'm showing the production cost over here, in case of absorption costing, which is my full costing, I have direct material, direct labor, variable manufacturing overheads, and fixed manufacturing overheads here itself. See, whether I use absorption costing or I use variable costing, ultimately, when I'm calculating the cost, I have to calculate the I have to calculate the total cost. But how you calculate it, that varies in both the situations, right? So here you have fixed manufacturing overheads here in the production cost itself. Rest, everything remains the same. Whereas if you talk about the same thing under variable costing, you will see here you have only direct material, direct labor, variable manufacturing overheads. And as far as your uh, fixed manufacturing overheads are concerned, that is considered here and in the last. So you can see ultimately when you have to calculate your total cost, when you have to calculate your total profit, when you have to show your income statement, both the things, are taken care of in both the methods. The only thing is where you have to consider it. In case of variable costing, in production cost, you will not show your fixed manufacturing. You will show it here in the end. Whereas in case of absorption costing, you show your fixed manufacturing overheads as a part of production cost, right? So with this, we come to the end of your cost concepts. Anyone having any doubt? Or I can proceed with the next chapter.
Please proceed, madam.
Okay, fine. Then we move on. Now see, in the previous class, we did CVP analysis, and in the present class, we had just covered cost concepts. So now the basic concepts related to decision making are clear. So with the help of these concepts, now we'll try to understand what exactly do we mean by decision making, or the technical term that is incremental analysis. Now see, whenever you have a choice, or suppose you have different options available, right? So under different options, only you need to take a decision. See, if only one thing is available with me, then I don't have a choice. I have to go with it. But if I have a choice, then I need to decide that which is the best one, right? So in that case, then you have to evaluate all the alternatives that are available and then arrive at a valid decision. So when you evaluate each and every alternative and you make it a problem solving tool, so in that case, you have basically three cost concepts. Those three cost concepts are relevant cost, sunk cost, and opportunity cost. When I use the term relevant cost means that you know that under different options, the costs and revenue, they are different among different alternatives, right? So in this case, there might be certain relevant costs. Now, for example, how do we study this relevant cost? Say, for example, you have to decide whether to buy a new machinery or to get the existing one repaired, right? And in both the cases, you know that insurance and maintenance cost will be different. Insurance and maintenance will be there, but both will be different under different options, right? So if I go for new machinery, then what will be my insurance and maintenance? That becomes relevant for the new machinery. If I go for the other one, that means repairing the existing one. So what will be my insurance and maintenance cost? That will be relevant with the existing one, right? And but when I talk about the revenue earned might be the same for, under both the situations, right? So revenue, when it is same, so that you don't have to consider because you know that you are going to earn the same amount of profit. But now whatever is different, whatever is relevant with respect to a particular decision, that is to be taken care. Second is your sunk cost. Sunk cost means the cost that have already been incurred in the past and now it will have no impact on your present decision making process. As such, they are never ever relevant. Say, for example, in the past, you have incurred certain expenses. Say you bought a machinery, right? You bought a machinery which is not earning the profits or revenue the way you wanted it to earn, right? So that cost that you have incurred on that machinery is your sunk cost. And whatever has been incurred in the past, whether you like it or not, you cannot change it. You cannot recover it. So now you have to take if you have to take a decision that you need to go for a new one, so that the previous decision of buying that machinery will have no impact on the new one. Ultimately, the new one has to be purchased. And the last one is your opportunity cost. Opportunity cost is the cost of foregoing next best option. The usual example in this case that we take is a cup of coffee and a cup of tea. So when I say a cup of coffee and a cup of tea, now that means we have two options. Either you can go for a cup of coffee or you can go for a cup of tea. You might choose coffee, I might choose tea. Now, why do we choose it this way? We choose it the way we like it. That means the thing which gives us more utility, more satisfaction, we'll go for that. So in this case, what happens is, suppose you are more fond of tea, suppose you are more fond of coffee. So whether tea is available at a lesser price, but still you would like to go for coffee. For me, coffee I know is more costly, but for me, tea is a better satisfaction giving drink. So no matter I can afford coffee, no matter coffee is available, but still I would like to go for tea because that gives me more satisfaction. So if I am choosing tea, so I'm foregoing coffee. So for me, the opportunity cost is coffee. For you who has chosen coffee, for you, the next best option is tea. So for you, the opportunity cost is tea. So depending upon whichever thing you have chosen, so that means you have foregone the next one, right? So that next one is your opportunity cost. So ultimately, when we are talking about this incremental analysis or what we call it as differential analysis or what we call it as marginal analysis, we try to solve the complex business decisions in this. So in this case, we use the cost behavior concept. We, you can say, evaluate all the pros and cons of the all the alternatives that are available, and based on that, then we take the final decision. Now, when I use the term final decision, the decisions can be of various types. What kind of decisions? Like you can have special order decisions, limited resource decisions, make or buy decisions, repair, retain or replace equipment, sell or process further, and eliminate an unprofitable segment or product. See, at a glance, if you just look at the last one, you will say certainly if it is unprofitable, then it should be shut down. Here, what we are talking about are short-term decisions. In the long run, everything is variable, and many other things are also to be taken care of. So in the long run, when things are to be studied and decisions are to be taken, then they are taken at a different level. So here, when we are talking about, we are talking about each and everything at the not in the long run, but in the short run, right? So in the short run, how decisions are to be taken? Let's see. We'll start with the first one, that is special order decisions. Special order decision basically means when you get an additional order, additional business order, right, to offer the product at a concessional price to a specific customer. So in this case, what will happen? In this case, you have to see that your normal routine sale is not disturbed with this. Your routine sale is going as it is, as it was previously going. You continue with it, right? And apart from your routine sale, there is an additional sale order that you have received. But with respect to that additional sales order, you have the operating capacity. Because if you are already operating at 100% capacity, then in that case, you will not be able to accept that new order, because to accept that new order, you will have to further have more plant, more machineries. That means more fixed cost is to be incurred, right? So all the things are to be taken care of. The practical question will give you a better idea. A manufacturer of plastic buckets makes an average profit of 2.50 per piece on selling price of 14.50 by producing and selling 60,000 pieces at 60% of potential capacity. His cost of sales is direct material 4 per piece, direct wages 1 per piece, factory overheads which are variable 3 per piece, and selling overheads variable 0.25 per piece. Total fixed cost is 2,25,000. During the current year, he intends to produce the same number of units, but anticipates that fixed cost will go up by 10%, material and labor cost will go up by 5% each. Under these circumstances, he obtains a bulk offer for a further 20% of his capacity. What minimum price you would recommend for acceptance to ensure an overall profit of 1,60,000? Right? Now, in this case, see, whenever you come across such questions, first of all, I mean, there are so many details given that many a time students, they just get confused how to proceed. The simple formula is you start with calculating the contribution. Once you calculate the contribution, things will automatically get clear how you have to proceed with it, right? Now, see, in this case, I'll do the calculation at two levels, one for per piece and the other one for total, right? You are operating at 60,000 units right now, where your direct material is 4 per piece and there will be an increment of 5%. So that makes it to 4.20. So the total will be 4.20 into 60,000, that is 2,52,000. Similarly, for direct labor, it is 1 plus 5%, that will be 1.05, total 63. Variable factory overheads 3 per piece, so total will be 1,80,000. And variable selling overheads will be 0.25, that will be 15,000. So if you just do the total of this bracket, this is my total variable cost. So which comes out to 8.50 per unit, and total is 5,10,000, right? So my contribution comes out to, see, if you remember the CVP analysis chapter, in that I told you that whenever you are talking about this contribution, it is sales minus the variable cost, right? Sale price is already given to you, variable cost you have calculated. So sales minus the variable cost is your contribution per unit is 6 rupees, and total comes out to 3,60,000. Now, This is the amount of contribution that we have to achieve. Now, fixed cost is given to you as 2,25,000, right? And apart from that, they are saying there will be an increment of 10%. So that makes it to 2,47,500. Because it is 2,25,000 plus 10%, that will be 22,500. That makes it to a total of 2,47,500. So when we have to calculate the profit, now profit is contribution minus your fixed cost. So in the present scenario, my total contribution is 3,60,000 and my fixed cost will be 2,47,500. So even without accepting the new order, my present profit is 1,12,500. But apart from this, they have given in the question that there is a target profit of 1,60,000. Out of this 1,60,000, 1,12,500 I'm already earning. So that means I need to earn extra profit of 47,500 from the additional order. So if I'm able to earn that much, then I can accept it because my target profit will be achieved, right? So in that case, let me see how many units and how much price I can keep. I have 20,000 units for the additional order. And if I just work on the variable cost concept, because in this case, we say that we only consider the variable cost. And if any additional fixed cost is to be incurred, then it is to be taken into account. Now my variable cost per unit is 8.50, right? So that will be 20,000 into 8.50. So my total variable cost from the new additional order comes out to 1,70,000. By all means, I need to recover that. And apart from that, I have an additional profit that I need to recover. That is 47,500, right? So the total value that I need to recover from the entire order should be 1,70,000 plus 47,500. That is 2,17,500. So the selling price, the minimum amount of selling price that I need to keep for this additional order should be the total amount that I need to recover upon the total number of units, that is 20,000. So it should be 10.875. So your special order decision can be taken if this price is available, right? Next is make or buy decision. See, many a times, the organization is faced with a problem so as to, they have to decide whether to manufacture a particular part or to purchase it from the market, right? If you want to take a decision on this, first of all, you need to consider various factors, whether you have the surplus capacity to produce it, whether the variable cost of producing the product or the part under consideration, you can take care of it. Then if you are talking about outsourcing it, whether it is related to firm's core competency or not. If it is related to core competency, then certainly it will be better to produce it, right? Then if you produce it, whether you will be able to supply it on time or not, if whether you can avoid the fixed cost or it has to be incurred. If yes, it has to be incurred, then how much, right? Then if you are incurring the fixed cost, then there must be some opportunity cost also. Then what is the opportunity cost? Is the opportunity cost lower than the present component or higher, right? Then you also need to see that if you are deciding to produce it, whether you can use the available resources, available facility for any other product manufacture or not. And if yes, then what are the differences between the revenues and the profits? So all these decisions can be taken. So in this case, again, you can just have a look at the example. Auto Parts Limited has an annual production of 90,000 units for a motor component. The component cost structure is as below. Materials 270 per unit. Labor, which is out of which 25% is fixed, 180 per unit. Expenses, variable and fixed, that is 90, variable is 90 per unit and fixed is 135 per unit. The total comes out to 675 per unit. The purchase manager has an offer for supplier who is willing to supply the component at 540. Should the component be purchased and production stop? Secondly, assume the resources now used for this component's manufacture are to be used to produce another new product for which the selling price is 485. In the latter case, the material price will be rupees 200 per unit. 90,000 units of this product can be produced at the same cost basis or as above for labor and expenses. Discuss whether it would be advisable to divert the resources to manufacture that new product on the footing that the component presently being produced would, instead of being produced, be purchased from the market. Now, when we actually start with this, as I told you, that whenever such a question comes, you need to just move ahead with the sales, variable cost, and contribution, right? So we start with it. I simply start with my variable cost first. That is material 270, labor, out of which 75, out of 180, 75% is variable. So I just consider that, that is 135. Then you have variable expenses, that is 90. So your total variable cost, if you produce it, will come out to 495. Whereas the supplier is supplying you the product at 540. So if you produce it on every unit, you are going to save 45. And fixed cost, by all means, you have to incur in every situation, right? And there is an additional savings of 45. So in that case, on 90,000 units, your total savings will be 40,50,000. Right? Now, moving on to the next part of the question, which says that we need to study the cost implications of the proposals to divert the available production facilities for a new product. In this case, what we have to do is, let's see that what are the options available under new product. The selling price per unit of the new product is 485, and the variable cost for manufacturing the new product is material 200, labor 135, expenses 90. So variable cost is 425 and contribution is 60. See, when we were talking about the first case, here my contribution was 45. Here my contribution is 60. So I can see the overall contribution is an additional 15 rupees in this case, right? So if it is an additional 15 rupees, so on 90,000 units, that will come out to be a total of 13,50,000. So it is advisable to divert the resources to manufacture the new product, right? So if I talk about the initial case, in this case, it was better to produce rather than to get it from outside because you were saving a big amount. But now when we discuss about the opportunity cost, because you know that you can utilize these resources for the manufacture of some new other product also. So in that case, there is an additional savings, or you can say additional profit of 13,50,000. So if you want to go for, then you can manufacture the new product. Next is your sales mix. Now, sales mix basically comes into picture when you are dealing in more than one product. See, if you're dealing in just one product, then you know you have to sell the maximum number of units of your own product. That's it. But if I'm dealing with more than one product, then I need to decide that how many units of which product should be sold so that I get the maximum profit. Right? So in this case, how do we decide? Allied Manufacturing Company gives you the following information. They have two products, product A and B. Fixed overheads are constant, that is 10,000 per annum. Direct material per unit, 20 for A, 25 for B. Direct labor per unit, 10 for A, 15 for B. Variable overheads, 100% of direct labor. Selling price per unit, 60 for A and 100 for B. You are required to present a statement showing the marginal cost of each product and recommend which of the following sales mixes should be adopted. Where they have given you 4 different options: 900 units of A and 600 units of B. Second, 1800 units of A only. Third, 1200 units of B only. And fourth, 1200 units of A and 400 units of B. So out of the 4, you have to decide that which one to be accepted, or which one should be the most profitable one. Now, first of all, we need to prepare a marginal cost statement in this case. That means, again, you need to proceed with the contribution. So I just start with my marginal costing. or you can say variable costing. So I start with direct labor for A and B, direct labor, direct material for A and B, direct labor, and then variable overheads. So my variable cost for A is 40 and for B is 55. Selling price for A is 60 and for B is 100. So ultimately my contribution in this case is 60 minus 40, that is 20. And in B, it will be 100 selling price minus variable cost 55, that is 45. Now, once your contribution is calculated, now let's see which option gives you the best amount of profit, because the higher the profit, the better it is for the organization. And every organization, they have to go for the maximum amount of profit. Starting with the first sales mix, where they have given you 900 units of A and 600 units of B. Now, contribution for A, we have calculated 20. For B, it is 45. So the total contribution will be, for A, it is 900 into 20, that is 18,000. For B, 600 into 45, that is 27,000. So the total contribution comes out to 45,000. And my fixed costs are 10,000. So my profit, that is total contribution minus the fixed cost, is 35,000. Similarly, I solve it for B also, but in case of B, my number of units for product B is nil. So that means I have only units of product A, and in A, I have 1800 units. And the contribution for A is 20. So the total contribution will be 1800 into 20, that is 36,000. Minus fixed cost of 10,000, that gives me a profit of 26,000. In option C, you can see that I have only units of B. Units of A are nil. So in this case, the contribution of A is again to be taken as nil because units are not there. For B, the contribution per unit is 45. So that will be 1200 into 45. The total contribution comes out to 54,000 minus the fixed cost, that is 10,000. Profit will be 44,000. Now moving on to the last option available, where you have 1200 units of A and 400 units of B. In this case, for A, my contribution is 20. So that will be 1200 into 20, that is 24,000. For B, it is 400 into 45, that is 18,000. So the total contribution stands out at 42,000. My fixed cost again remains the same, that is 10,000. So when I subtract my total contribution and fixed cost, I get the total profit as 32,000. So you can see under all four options, I have four different amounts of profits. So among these four different amounts of profits, I can see that option C has the maximum amount of profit, that is 44,000. No matter my product remains the same, A and B, I am not changing my product, but out of the available options, C is giving me the maximum amount of profit. So C is the most recommended option, most recommended sales mix. This is known as sales mix. Why sales mix? Because how many units of which product are to be sold, that will form your sales mix. Because you have more than one product in which you are dealing, right? So as a result, in this case, I will go for C as the best option, as the best sales mix, no matter I can see that in case of option C, we are not going to sell any units of A. But still, even in that case, we will prefer to go for this only, because that is the most valid and most highest yield giving profit, or sorry, highest not yield giving, highest profit giving option under the available four options, right? So this is known as your sales mix decision. Any doubt as of now? We are still to continue with the same topic, and that we'll be doing it in the next class, because it's almost, I mean, the time is up, so I will not be continuing right now. Any doubt as of now?